Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thank you for joining us. So today, Josh and I thought we would talk about how consensus in the capital markets and in the economy is almost always wrong, and recent history proves that to be true. So if you go back 2.5 years ago and you think about when the Federal Reserve was talking about the inflation we were seeing in the system being transitory, the Fed thought it was a temporary thing and it would take care of itself and the Fed wasn't going to have to act on it. Obviously that turned out to be wrong. Inflation, Josh and I thought, how in the heck could this inflation be transitory? Money was being sent out to the American people. The money supply increased by 40%. And so we believed that it wasn't going to be transitory and the Fed was going to have to deal with it. And that's certainly what happened. And if you go back to recent history, everybody out there thought that the economy was going to weaken significantly and inflation was going to continue to roll over and the Fed would be aggressively cutting interest rates, certainly by now and into 2024, where rates would be sharply lower. And that has turned out to be wrong as well. And so the reason Josh and I didn't think that was going to be correct is we live in this thing called society like the rest of you. And we go to airports and we go to restaurants and we go to shopping malls and we go to, we spend time in society, and we saw the behavior of the American people. It was very hard for us to imagine that inflation was going to roll over sharply and that we were going to head into a recession when we were seeing the actual behavior. So on Tuesday, we got the inflation data for the month of January, and inflation was higher than anybody had expected for the month of January. And so the stock market sold off because what the stock market interpreted that is that the Fed wasn't going to be cutting interest rates anytime soon. And that was our take all along. We were looking at the economy and we said, why would the Fed need to be cutting interest rates? In fact, it doesn't really feel like the interest rate environment we're in now is all that restrictive when you look at what's going on in the economy. Now, we are starting to see cracks around the world, and that may cause the Fed have to start cutting rates in the second half, but we don't see this aggressive interest rate cutting that most of the capital markets seems to think is going to happen. The other thing we were getting from the Federal Reserve, Jerome Powell, the chairman of the Federal Reserve, was on 60 Minutes and he sent out his minions to say, look, we are going to get inflation back to our 2% target, and they're still a ways away from that. So this so-called last mile and getting inflation down to that 2% is going to prove to be the most difficult. So it doesn't really feel like interest rates are all that restrictive here. It sort of feels like maybe we're at the neutral rate. And so the stock market is having to digest that. But, it doesn't mean that Josh and I aren't still optimistic about the capital markets in 2024. We are. I mean, there's going to be volatility. The stock market was up 26% last year, but we had two sharp sell-offs. Remember, one in March and one in October, and stocks ended up having a really good year. We think that this year will probably be something like that. Maybe not quite as good a year in the total return factor, but in terms of, we're going to see some volatility as it relates to what happens with interest rates.
You definitely saw some premature celebration from Team Transitory. For those of us that are believers in the more structural nature of inflation, the labor market and the mass exodus of baby boomers from the workforce is the theme that matters the most to us. The catch-22 here, of course, is that the longer rates stay elevated, the higher the likelihood of a recession ultimately. I don't know if we'll ever end up seeing 2 quarters of negative GDP growth, but you're certainly starting to see a return of the dynamics that existed before COVID. There's been an increasing number of layoffs, particularly in the tech universe. Japan officially entered recession as of this morning. The European Central Bank also cut their growth forecast pretty dramatically, expecting 0.2 or 0.3% growth in the forward year, which is about a quarter of what they'd forecast just a few months ago. But that same paradigm exists, that inflation is structural in nature. Rates are going to continue to be elevated for longer than most market participants are currently pricing or expecting. If you look at Fed funds futures, they're essentially just a gambling perception of what gamblers think is going to be the future. They have been dramatically inaccurate over the last couple years, and we tend to still actually think that's going to be the case. This is an inflation print that the Federal Reserve is going to have a really difficult time ignoring. I know Austin Goolsbee, the Chicago Fed president, was out there yesterday saying that it was just noise. It doesn't really seem to be for those of us that sort of pay attention to the real world. And super core actually re-accelerated, shelter prices re-accelerated, recreation re-accelerated. All of those things that we all purchase and see and watch everyone else buying indiscriminately continue to drive inflation forward. And so, we again think the Fed will be wrong, but stocks have done very well in interest rate environments that are very similar to what we're experiencing today. So earnings are ultimately what matter, and they continue to be significantly better than expectation.
Yeah, ultimately, I think the U.S. economy is certainly better than anybody would have expected at this point in the cycle, us included. And so, expect volatility. We haven't had much volatility to the downside since October, and so we expect some volatility in the months to come. But it shouldn't shake you out of the markets. Remember, it's time in the market rather than trying to time the market. As always, if you have questions about your account or your situation, you can call us at the office, 800-743-0988, or email either one of us, Josh or Tyler, at northwestquadrantwealth.com. We'll see you back here in 2 weeks.